Good afternoon. My name is Stefan Dercon. I'm at the Blavatnik School of Government and involved in a program called Digital Pathways at Oxford. And this is our second seminar in the series. And it's with great pleasure that I welcome today as our speaker, Jenny Aker. Jenny is a professor of development economics at the Fletcher School and with the Department of Economics at Tufts University. She's also the director of the Fletcher Leadership Program in Financial Exclusion, deputy director of Hitachi's Center for Technology and International Affairs, and the co-director of the Center for International Environment and Resource Policy. She's also a non-resident fellow at the Center for Global Development, just like me, I think. And it's just great to have her here. She will present her paper, Migration, Money Transfers and Mobile Money, evidence from Niger. And I just look forward to hearing from her, and then hopefully we can have a great discussion subsequently. Thank you. Jenny, over to you.
Great. Thank you so much, Stefan, and thank you so much for letting me be here today. I'm very excited to be here and to be talking about this topic. Stefan and I think we started talking about this topic several years ago, and this is joint work with Sylvia Prina at Northeastern and Jamila Welsh, who's also at the Tufts University. So overall, the motivation for this research is pretty simple and maybe not very deep, which is that money transfers are important. I don't think I need to convince many of you who are sitting in this webinar about the importance of transfers in your personal lives, but even more broadly for productivity, growth, and development. Many of us make transfers to friends and family members if we go out for a meal and maybe share that, or if we want to lend money to a family member. We receive salaries, cash transfers, and benefits from our governments. We buy goods and services from businesses, and businesses kind of buy those goods and services from each other. And when we started thinking about this research, while all of these different types of transfers are important, the one we really wanted to focus on was remittances, quite frankly. And the reason of that is just in recognition of the fact that migration, quite frankly, plays a really important role in household welfare globally, but particularly in many low-income countries, and more particularly in sub-Saharan Africa. If we just focus on West Africa for a second, where I've done a lot of work, about 60% of households have at least one seasonal migrant, and about 70% of households also have a permanent migrant. And what that quite frankly means is that remittances account for almost as much as foreign direct investment and aid to the continent, and about 2.5% of sub-Saharan Africa's GDP. Now, over the course of the past few years, since the time we started this research, a second area where payments has been really important, and which many of us are living through right now, is in the area of social protection. We know that with the spread of COVID-19, many countries have implemented lockdowns, curfews, and border closures. And what that has meant has had negative impacts on those who have either lost their jobs, or particularly those who are working in the informal sector. And in response to that, it's estimated that about 215 countries worldwide had implemented about 1,400 social protection measures. Half of those are cash-based, and a majority of these are new or expanded programs. So what that means is that there's a real demand for getting cash in the hands of those who need it most, and sometimes those who are in remote rural areas. Now, if you're in a country, potentially a high or a middle income country that has a very dense financial infrastructure, then kind of transferring money either via remittances or as a social protection transfer might be quite easy. It's just a bank-to-bank transfer or potentially a prepaid debit card. But if you're in a country that has a limited financial infrastructure with limited financial institutions and potentially long distances, these transfers can be really expensive. And that's quite frankly because if you look at the figures, 1.7 billion adults worldwide are unbanked. They don't have an account at a formal financial institution. That's about a third of households in West Africa alone. And if we focus on that on the G2P side, what that means is that governments and other types of NGOs are paying, quite frankly, these cash transfers in cash. In 2017, the most recent data, that was 100 million people received their social protection payment in cash. And if you focus on the remittance side of things, that means it's also quite expensive to transfer money between members of the same family. It's estimated that about cross-border transfer costs in sub-Saharan Africa are some of the highest in the world. The average is 11%, but that ranges from 1 to 29%. Now, the good news is that with the advent of mobile phones, there really are these different potential for implementing cash transfer programs and reducing the costs. We know that about 2/3 of unbanked individuals have a mobile phone. And with the advent of mobile money, which we're going to be talking a lot about today, which was introduced in 2008, there's been kind of widespread growth throughout the world. There's almost 300 of these worldwide. 60 of them are in West Africa. This really has the potential to reduce the cost of transferring money between individuals and between governments and individuals. And if you look at that map on the right, what you basically see is where the early growth was primarily in East Africa. Over the course of the past 7 or 8 years, there has been some growth in West and Southern Africa as well. And it really seems as if, looking at some research, that kind of this potential has really lived up to the promise. There's been a series of studies in Niger, Kenya, Tanzania, and Rwanda that show that using mobile money reduces the cost of G2P and P2P transfers. As a result, it allows households to get access to these remittances or private transfers that then in turn helps them to smooth their consumption in the face of shocks, and then improves their savings and reduces poverty in the long run. And if you look at this graph to the right, which is some work that we had done in Niger about 10 years ago, we found that basically using mobile money for a simple cash transfer program less than half the cost of getting money into the hands of remote rural beneficiaries. Now, despite all of that, the digital promise has some kind of challenges as well. And what we've seen is that the adoption of mobile money, despite the fact that it seems to be welfare improving, is only about 30% in West Africa. That's compared with 75% in Kenya. There's huge variation by country within the region, as we can see on the right-hand side. And there's a stark contrast between mobile money adoption, meaning do you have an account, have you signed up for it, and usage, are you actively using it? It's estimated that about 1/3 of people who have an account are using it in an active way. And so the real kind of idea for this research was to say, well, kind of why is the adoption of this technology that seems to be so profitable so low? There could be a number of reasons for this in terms of having information about it, beliefs on the supply side and the demand side. And what we were looking at was the fact that a number of studies on technology adoption really focus on the demand side of things, information constraints, financial incentives, and nudges. But we know that supply plays a crucial role and often overlooked. And so the approach in this study is to look at both the supply and demand side factors affecting the adoption of mobile money, in focusing on the Niger, which is one of the poorest countries in the world, yet has a very high demand for money transfer services. And we do this by looking at a survey of money transfer providers on costs and services, in addition to a household level survey on how they're using money transfers, their beliefs about it, as well as a willingness to pay experiment. We find 3 things, which I'll just preview here, but then talk a little bit more in the next 10 minutes or so, which is one, there is kind of a lot of money transfer services within Niger. There's about 45 of them, domestic and international. So there seems to be kind of some supply that's available. And that coincides with the fact that rural households have significant demand for money transfers. About 70% of them had received money in the past 6 months. They receive about 5 to 10 transfers over the course of the year. That being said, even though mobile money is one of their options, the use of it for private transfers is low, about 3% within our sample. There's similar rates of that by region, but households seem willing to pay for it. So their willingness to pay to send their transfer via mobile money is slightly higher than the market price for it. And then the question is why? Why is their usage so low, but they're willing to pay for it? And we really focus on this idea of agent density. Are there enough agents in remote rural areas? And then some aspects of awareness as well. So just to tell you a little bit more about Niger, in case you aren't familiar with it, it's a landlocked country in West Africa, one of the poorest in the world, but migration plays a crucially important role. About 50% of households have any migrants, and about 1/3 of them stay within Niger, with the rest kind of migrating either within West Africa to other countries within the continent, or in some places in Europe or the United States. What that means is that people are migrating within the CFA zone and across the CFA countries. It's also one of those financially excluded countries in sub-Saharan Africa, with one bank for every 100,000 people. But that being said, where we saw that there's this opportunity, mobile phone adoption is quite high, and it has been increasing since its introduction in 2001. And it ranges from about 60 to 90%, depending upon the region. So the data that we used is that we had a number of kind of data that we had done previously for other work that just allowed us to look at migration patterns to see kind of what rates of migration were I'm not going to be focusing on that today. I'm just going to talk a little bit about the supply side survey that we did, which was a census of these money transfer providers, as well as the demand side survey, where we asked households across 30 villages in 3 regions questions about migration, remittances, sending and receiving money, their beliefs about money transfer services, as well as their willingness to pay for mobile money. Now, what is willingness to pay for mobile money? In general, we could have just asked people that if you wanted to send $20 to someone, what would you be willing to pay? But in that case, it might not necessarily be incentive compatible. So what we have done is that we did a mini experiment using something called the Becker de Groot-Marschak mechanism, which basically we elicit households' willingness to pay. It's kind of a real stakes game. And part of that is that we prevent people with a kind of a sequence of prices, which you can see here on the right-hand side, and ask if they're willing to pay that amount to purchase a mobile money service. Now you might be asking, well, what does it mean to purchase mobile money? It's something that I use to transfer money to someone else. And what we did is that we said, well, we will kind of willingly send $1 to someone outside of the village. It could be a friend or a family member. And what you're bidding on today is the cost of us sending that $1 to someone else. So you're really kind of bidding on the cost of that service. And at the second stage, people choose this price out of a hat. If the price they choose is going to be kind of less than or equal to what they said they were willing to pay, they win and they pay for that service and we transfer the money, and otherwise they lose. So it's this real stakes game. The second thing that we wanted to do is get a sense of people's beliefs about different transfer services, about buses, about domestic transfer companies, as well as about mobile money, to see if people knew about the services, what they believed, did they have trust in it, did they think that it was expensive or not, thinking that this might be a constraint to the actual adoption. So what do we basically find? As I said previously, there's about 45 companies that exist within Niger. They're primarily focused on transport companies. So you can think of buses or small transport, but also international companies like Western Union or MoneyGram, domestic transfer companies called Benif Afua. But then there's some variation about whether or not they have offices in rural areas. Whereas mobile money, which is the last column, always has offices in mobile areas, meaning kind of they have some agents. Transport companies are about 50%, whereas the international and domestic companies have no sub-offices in rural areas, which means that there might be some type of barrier to getting access to them. On the demand side of things, on the household side of things, as I said previously, within our sample, about 70% of households had one type of migrant. 70% of them had received a transfer in the past year, and a majority of them had a mobile phone. So all the elements here are to say that people are using kind of transfers for remittances primarily. They have this technology, and there are a number of different transfer tools at their disposal. So what are they using to transfer that money? Well, as I said previously, they're doing about 5 or 10 transfers a year. And what you can see here is what they're using. So very few of them are using the post office or Western Union. Almost a majority of them, 3/4, are using a friend and family member saying, hey, if you're going to that area, would you mind taking that money for me? That's followed by using this domestic transfer service that I mentioned previously. And smaller amounts are the bus. And then we see coming in kind of third from the bottom is mobile money. So about 3% of the sample. Now, in terms of kind of the cost of these types of things, what we basically see is that it seems as if the sender is paying to send the money. So that fee is not necessarily borne by the recipient. So that's important to think about who's deciding which technology to use. But they do have to pay some transport fees. About 1/3 of them are paying transport to go and pick up the money. So that's a non-trivial cost. And overall, if you look at kind of the total fees as a proportion of the transfer, it's about 9%. So remember that 11% figure that I had talked about previously in sub-Saharan Africa, which ranged from 1 to kind of 29%. It's about slightly below what we see in sub-Saharan Africa. So even though people are only 3% of households are willing to pay or are using mobile money, what are they willing to pay for it? And this is a result of that game that I talked about, this willingness to pay experiment. So on that y-axis, we see here the price. So we gave them all these hypothetical prices from free, 0, up to 500 or 250 CFA, which is about kind of the value of the transfer. And what you can see, kind of unsurprisingly, is that the price goes down. People are more likely to use mobile money. There is some difference by region. So overall, all the way to the left is Zander, which is a region that's all the way to the east of the country and farther away from the capital city. Doso, which is all the way to the right. So there seems to be a higher willingness to pay. That's closer to the capital city, but all of them have similar rates of migration. So they seem to be kind of migrating at similar levels. They're at similar agroclimatic demands. So the question is, why do we see this variation in willingness to pay? The interesting thing in terms of the average willingness to pay, which is what you see here is the red line, is about 76 CFA. That's going to be kind of about 30 cents. And that is slightly higher than the actual market price. If you wanted to transfer $1 to a friend or a family member, what people are willing to pay from our game is slightly higher than the actual market price. So again, there seems to be this kind of weird juxtaposition where we see that very few people are using mobile money, yet when they're offered the opportunity to kind of play a game and actually pay for it, where they gave us money at the end of the game, they were willing to pay slightly higher than the market price for sending that value. So the question here is why? So we looked at a number of factors in the demand and the supply side. The first was, do people even know about mobile money if only 3% are using it? Well, kind of about a third of the population, or a third of the people within our sample, had heard about mobile money before, and 12% of them had used it. So that isn't completely explaining kind of why we see such low usage, although that might be part of the story. When we asked their beliefs about mobile money and trust in its quality at price, over 95% had very high beliefs that mobile money would actually be something that would be effective. They had quite accurate kind of beliefs as well about the cost of mobile money as compared to other types of money transfer services. And if you look at the prices of alternative products, mobile money wasn't necessarily more expensive as compared to some of the domestic money transfer services. Although I'm happy to talk about this in the chat, there was a little bit of difference between kind of what the official price was and what people actually had to pay. What we really then focused on was the supply side. Were there a sufficient number of agents in rural areas? And remember how mobile money works. Obviously, you have to go to the agent and pick up your money, as is the case with a Western Union agent or anything else. And if you look at kind of the agent density in the rural areas where we're working, what we found is that there was very low agent density. There was density in one region where we were focusing on, which had the highest willing to pay. There were agents in 12 locations. In the area that had the lowest willingness to pay, they had agents in 3 locations. In most of these cases, there was only one agent for every single location. So again, kind of a very low density. And it was much harder to find a mobile money agent in Zaire. Again, the region with the lowest willingness to pay, with the distance going to an agent varying between 17 and 43 kilometers. And if you were walking, that would be about 6 to 8 hours walk, which is really long. This coincides with what we've seen in terms of agent density in rural areas across sub-Saharan Africa. We know that there are more mobile money agents as compared to banks, but it's still estimated there are about 228 agents per 100,000 people. And so again, kind of the density of this is not necessarily reaching the level that we've seen in certain countries, such as Kenya and Tanzania. So what does this all mean? What this means is that kind of with this bottleneck, with these relatively higher prices of transferring money, this suggests there might be a case where remittances aren't necessarily being received when they're actually needed, which is some work that was found in Kenya and Rwanda. And by improving access to remittances, this potentially improves consumption smoothing. Secondly, this means that remittance costs are higher for migrants and their families, reducing kind of the income that is available to them and for them to use. And third, if there were this reduction in mobile money transfer costs, just focusing on this one technology, this would kind of increase GDP in Niger by about 1%. So what does this mean for us in terms of policy? And I would love to have a debate on this and discuss this a lot more. But I think the 3 things that we found by looking at this, just broadly speaking, without really focusing on the whole, is that access to this basic technology, the mobile phone, is there. And so if we're going to kind of leverage that, we really need to continue to use that basic technology. It just could be a simple feature phone. It doesn't need to be a smartphone. But what does need to happen is really focusing on policies that ensure affordable and quality access to these basic digital financial services, focusing primarily on the agent network and something else, which is interoperability. So allowing kind of transfers to happen across different mobile money providers, but at the same time, across different currencies, if you're thinking about the CFA versus the non-CFA zone. Now, how do we actually do that? And this is something that I really want to discuss here in the chat, but I think we really need to think a little bit more about what are really the constraints to agent rollout in West Africa. Is it defining who can actually be an agent? Is it the incentives to recruit and retain agents? Is this a regulatory issue, a provider issue, or both? And what types of services can really push rollout? We've seen before that potentially by using kind of mobile money for big social protection programs, that maybe that can kind of spur supply in certain areas. It's a little bit of a chicken and egg problem. Or can related technologies such as a code d'envoi, which again, I'm happy to talk about and define, be used instead of or as a complement to mobile money. So I'll end it here and happy to take any questions and engage in the discussion. Thank you so much.
Right. Well, thank you, Jenny. Can I actually start myself by asking a few questions, and then please, the people in the audience that start putting the questions as well, as requested in the chat. So the first thing I want to ask you actually is that it strikes me, just on the paper itself, I don't know the numbers at all, but does West Africa now, and where you're working there, that sounds like particularly different from at least what I thought I tend to know about East Africa. Yeah, and I want to just actually, a lot of people will know about M-Pesa and so on. Could you just confirm that, and whether you have an explanation, whether your list of explanations, how you think they would fit in with some of these other contexts? Yeah.
In terms of the demand side and the supply side, is that?
Exactly.
Yeah, I mean, I think that when you go back kind of to the inception of M-Pesa in Kenya, and then kind of what we've also seen with the rollout in Tanzania, I mean, there were, in the early years, there seemed to have been a real focus on building out that agent network. So potentially looking at these remittance corridors, not necessarily saying we're going to go to areas potentially where it's lowest cost, where there are paved roads, but saying where there's going to be the highest demand, right? So by doing it that way, you build this agent network, and with that agent network, again, people know who you are. If they know who you are, they can go to you, they can visit it, and it builds upon itself. That's the first thing. The second thing I think is, something that's non-trivial, is that you have, in the early days of M-Pesa, as I understand it, I mean, there was a lot of willingness for many of the regulators to really try and to innovate and to say, this is something that's new. It's a new product that we aren't necessarily classifying as banking, right? And we're going to allow some innovation to happen in terms of how agents are defined, kind of what that means for the trust, and doing so then allow kind of this agent network to grow. And then what we've seen is that with awareness comes increased adoption, with adoption comes more supply of agents, and so on and so forth. So it's just like a very dynamic equilibrium. That's in contrast, I think, to some of what we've seen in West Africa, where maybe kind of mobile money has been used for specific social protection payments, but after that stopped, then there was no longer sustained demand for using mobile money. And what that meant is that potentially agents no longer kind of stayed as agents, or they didn't necessarily have the liquidity that was required. So when people visited them, they couldn't get their money out. Right,
that's interesting. If I just could follow up with one more question here, is that, from a policymaker's point of view now, you clearly give the impression, what you just said now, in other contexts, there was this kind of push to create this kind of environment to get further. I mean, so where would you now put it? Like talking to the policymakers in where you were working, where would they start? What are the kind of other things they need to do? We see there's constraints on all kinds of things. So where do you push? Where do you think they have the levers to push?
I mean, I think that there's a few places where they have the levers. The first one is, how you're actually, what definition you're going to be giving of agents. We saw at the early rollout of many mobile money services, there were very strict definitions of agents in terms of they had to be these formal entities, and then or they had to have kind of an actual stand, and then that was kind of broadened to informal entities who could potentially be itinerant. So first of all, kind of the question is, how are we defining agents, and what is necessary to be considered to be an agent? The second question is, and this is going to be really important, is kind of what is the pricing scheme that we're offering kind of these mobile money services, right? Are MNOs being taxed to a certain amount for providing mobile money services? If they are being taxed, what does that mean for the margin for these services? Not just for the margin that they are earning, but the margin for the agents themselves. And then the third thing is going to be kind of, is this kind of technology going to be used in order to implement salaries for teachers, doctors, nurses, for social protection programs? Is this a potential lever that could be used in order to really kind of spur demand and then simultaneously spurring supply? So I think it's this three-pronged thing, looking at the regulatory framework, which is of course going to be really important when you're looking at the CFA zone. You're thinking about all of those countries, forget about individual countries such as Nigeria and Ghana, but then also thinking about kind of how it could potentially be used as a way to potentially spur demand and hence supply.
So that's excellent. It's very clear. So I'm looking at the chat at some of the questions, and I think implicitly, and I know Alison Gilwalt was asking a question. If she doesn't think you've answered it, what you just said, maybe we could come back. But maybe I'm not sure whether we can get. I think Ricky, would you want to Ricky Coughlin? Would you want to ask the question from the floor? Maybe it's the nicer way.
Hi, Jenny. Hi, Stefan. Can you hear me?
Yes, perfect.
Yes.
Thanks very much. Yeah, I had just a question. Yeah, as I said, recognizing the importance of mobile money in supporting remote financial services during COVID-19. We've seen that in the last year, and the importance of it. Several countries we've seen have adopted measures to encourage the use of mobile money services. In many countries, the measures have been adopted to make usage of mobile money less costly, less burdensome, including, the relaxation of regulations. But how do you see these measures, risks to stability of the system in deregulating the sector? And I suppose also, are there learnings that could be incorporated longer term?
Yeah, I mean, I think that that's going to, I would love to talk a little bit more about some of these specific measures in terms of kind of what's being done and which kind of measures are being relaxed. I mean, obviously, in the case of any kind of central banker or Ministry of Finance is to balance these different types of risks, so the stability of the overall system while as kind of promoting growth. I think what we have seen worldwide is to say that there are so many different models that potentially could be used to kind of promote the growth of the agent infrastructure, that there's a lot of lessons to be learned. And so I think that we're going to be using this period as one to say, in some cases in Togo, for example, they're really rolling out mobile money as part of their Novisi program. And I think part of this is going to be asking the question, well, how successful was actually getting that into the hands of the people who need it the most? And does that kind of promote sustained adoption or usage of mobile money? So the short answer to your question is, I don't really know, but I do think that there's kind of a lot of evidence over the course of the past 10 or 12 years of different models, some with kind of varying degrees of success. And then the question is, how much are they actually putting kind of the overall economy at risk?
Okay, so I have a question from Donna Harris in the chat. So maybe Donna, you can ask them. It's more technical on the way you've done the paper, but I think it's worthwhile expanding a bit more on that. Donna?
Thanks, Stefan. Hi. Hi, Jenny. Thanks for the interesting talk. So I have actually two questions. I mean, the first one is a bit more broad. So in terms of financial literacy and financial inclusion in Niger, I mean, if you can talk a little bit about that, whether you looked at that. And the second point is around whether this is about costs or is it about more behavioral, psychological factors, for example. So we're doing a similar project in Central Asia with IOM, and we're also looking at supply and demand side, and we're thinking maybe something about having cash in hand, more tangible. Even people who have mobile phones, smartphones might not choose to, use the digital remittances because they like to have a feel of the cash. So I was just wondering whether you looked at that as well. And then the BDM, maybe we can talk offline.
Yeah,
Thanks.
No, that really important question. So I think, when you asked about the levels of financial inclusion in Niger, I mentioned that Niger, nationally is one of the most financially excluded countries in the world. Within our sample, about 1% of the population is using a formal kind of financial service. But that being said, as we know, people use lots of informal financial services, whether that's savings groups or borrowing from friends and family elsewise, in order to kind of smooth their consumption in the face of shocks. So in terms of financial literacy, what we see is that we're just focusing on literacy itself. About 85% of the population is unable to read and write in any language. That being said, that's kind of decoding information. If you were just focusing on numeracy, people are often kind of quite able to easily do these calculations within their heads and kind of at least kind of manage their finances via these informal networks. So despite the fact that overall kind of formal financial inclusion is low, we know that people are using a diverse range of products in order to kind of meet their needs. And then your second question, can you remind me again what that was? I apologize.
Yeah, about the behavioral and psychological factors of, maybe it's not just costs per se, but having cash gives that sense of security and there's also habit as another factor.
Yeah, I mean, I think that it was, and that was part of the game that we had done. I mean, so as I said before, a majority of individuals are using friend and or family members to send their cash transfers. Our sense in talking with individuals is that was more because you trust that individual as opposed to making sure that they receive the cash. About 35 or almost 40% of them are using these domestic money transfer systems. And that domestic money transfer system means that you actually go to an agent, you give them the money, and then the money is sent electronically. And it's usually verified via mobile phone, which is similar to, not exactly the same, but similar to sending that cash via mobile money, because just on the other end, they're cashing out and receiving that in cash. We did see, though, that, in a previous study about 10 or 11 years ago, that when people received a cash transfer via mobile money, they cashed out almost immediately. I don't know if that was actually due to kind of the ease of having cash at hand, or some type of mental accounting, or the fact that there was it was during the hungry season and people had a high demand for cash during that period. So love to talk to you more a little bit about kind of some of these behavioral elements, as well as the willingness to pay experiment.
I think Raluca had a follow-up question on this as well, related to Donna's question. Raluca? Raluca, can we get you? Seem to have lost her.
I see the question about kind of gender norms and what that might mean.
Why don't you pick it up? Yes.
Yeah, so I think there's maybe two things that we had seen. So previously, when we had done some work using mobile money as a cash transfer mechanism within Niger, the primary target of that was women. We found that women used it quite easily. They were able to go to mobile money agents, even if levels of literacy were not necessarily high. They memorized kind of their PIN number. And so there wasn't this constraint or this barrier to going and visiting a mobile money agent to actually cash out. And what we found is that it seems as if getting the cash via mobile money increased kind of their discussion or their inter-household bargaining within the household as compared to getting physical cash. And then the second side of thing within the context of this study, when we looked at willingness to pay, because we played this game with both men and women, we found that on average, kind of females were willing to pay a little bit less as compared to men, but it was less than 10% of the price. It was about 5% of the price, and it wasn't necessarily statistically significant. So, the question there is that due to gender norms? Is it the fact that they had less liquidity at the time that we were playing that game? And that is something we can't necessarily disentangle.
Right. Liz, did you want to come in with some questions?
Yeah, thanks, Stefan. Thanks so much for this, Jen. It's so interesting, and we were talking about this earlier. This was a paper that you started developing when we were the Pathways for Prosperity Commission, and it's really interesting to see how the data's emerging and evolving in the current COVID context, and just how the numbers of social protection programs have exploded. But I had two questions, just zooming out a bit. One is, do you think there's any value of having any sort of regional regulatory framework on this? And the second is, and you've spoken to this a little bit, but if I could just ask the question, it feels a little bit like the elephant in the room when we're talking about mobile money. The myth is now that you had M-Pesa, and then the door is now shut actually to any other country having a mobile money system that's successful because of the incumbency effect. I mean, you talked about there was there was much more latitude with allowing people to be agents, initially in Kenya, and then kind of everyone got wise to what that meant. Do you think that's going to be the case in the other countries, or is it just in countries like Niger that the incumbents are actually relatively politically weak, and so that they wouldn't be able to shut this down? Thanks.
Yeah, I think that the regional approach, it's an interesting one. Already with the BCAO, if you're looking at the WAMU, the CFA countries, there is inherently this regional approach, but then that only takes into account the CFA countries and not Nigeria, right? And Nigeria is crucial, extremely important. as a major kind of economy within the region, but also as a major source of remittances. And so really thinking about this in terms of the ECOWAC framework is crucial. That being said, what we've seen, if you go kind of on a country by country basis, they all have very different ways of approaching kind of mobile money agents and mobile money providers. And so I wonder how easy that would be to kind of have some type of kind of uniform regulatory framework. I think that the benefits could be huge, but then the question is kind of what are those costs, and is that even possible or feasible? It might be kind of getting back to Richie's earlier question, the potential that maybe you could agree on certain things like the definition of what an agent is and kind of what you do with those trust accounts and things like that. But I don't know kind of whether or not you could agree on things such as interoperability amongst different types of MNOs and things like that, which is trickiest even within one given country. In terms of Niger in particular, there are these 3-4 mobile money providers. Really in the beginning, it was kind of Zain, which then became Bartia Airtel, which then Orange came in and a few others. I would say looking at the country, there was some type of geographic distribution in terms of kind of where they really focused their efforts. But at least in my perspective, we haven't necessarily seen kind of any first mover who has gone in and really kind of said, this is going to be kind of our realm, whereas kind of other competitors couldn't necessarily come in. And so it seems as if there is kind of potentially a possibility for other firms to come in, but the question is it profitable for them? Kind of what is their income that they're earning on these mobile money accounts? And is this something where there could be some type of collaboration or kind of competition?
I wonder, well, we have a question from a Zoom name called Kiluk. I don't know whether it can come live, but it's on Tanzania. If we can hear the question live, why not? Any chance?
Hey, do you get me?
Yes, absolutely.
Oh yeah, I'm Kilgala. Yeah, I've seen mobile money providers in Tanzania in both urban and the rural areas, and which is good. I think they improve the inclusion in the society. My worry is, especially in the urban setting, do we expect to have a problem with the sustainability of banks because of potentially mobile money providers crowding out users of financial services from the bank?
Good.
Yeah, I mean, I think that it's a really great and it's an important question. And I honestly think that while there has been some research that's been done on this, I don't know if there's been a significant amount of research done on this, which is to say, if you're using mobile money, is it crowding out other types of formal financial services or crowding in, right? Are you just kind of saving more, but you're saving more across a wide diversity of products? I would argue, but you could maybe debate this with me and disagree, that really mobile money and many of the accounts that are being provided by banks are offering different types of products to different types of consumers. And maybe there kind of there's enough to go around, for lack of a better word, right? Mobile money allows you to kind of transfer these smaller amounts. If you wanted to save now with Tanzania, the fact that you can have interest on your savings in a mobile money account in Tanzania, it allows you to kind of save these smaller amounts, which you might not be able to do. And if you had to open a formal bank account where you might have to have a minimum account balance and have to pay kind of a certain interest rate. So kind of, I think that the jury is still out, but some of the work that I know from a colleague of mine who has worked on Tanzania and looking at the impact of the interest rate policy suggests that it's actually kind of crowding in savings, that those who are saving in mobile money are saving more across the board. But to be honest, I haven't looked to see whether or not they're also saving in banks as well, or they're just saving in SACCOs, kind of in informal institutions in addition to mobile money. But it's a great question and something to think a little bit more about.
No, it's interesting, Jenny, that you say that, and just to add to it, it's has struck me over the years that when you sometimes talk in ministries of finance or in central banks, this comment is quite often made. It's like, you're setting up a certain thing, but they don't know how to do it. They won't do the intermediation and so on. It's an interesting thing that getting good evidence on it. And I think what you describe of what your colleague has done is actually quite an important thing to start thinking a bit about it because it's still there. It's also, and I see another question in the chat here. Bob Morley, do you want to come live on and just explain a bit more what the question is? But I can also follow up on that.
Okay. There's a whole chain between the sender and the receiver, which has lots of links in it, and money attracts bad people like bees to a honeypot. Are the agents in fact mini bankers, and how does everything get authenticated? I'd like to just understand how that system works.
Can I add to that? Because I find quite an interesting thing is that we saw it emerging and people being very trusting about their phones and what is happening is. But the fact that you get in an area where actually there's very little going on, is that a trust equilibrium as well? Is there, say, maybe something there? Do you have any evidence, any stories even from things that may have happened and shifted that? Anyway, please.
Yeah, Bob, I think it's a really important issue because if you think about it, I mean, so part about the security or trust issues, right? There's like a sticker price for what you're paying for mobile money. And then when you arrive at the agent, it's what the actual price is that you pay. And that's kind of a dynamic of three different things, which is number one, do you know what the actual price is? And do you understand what the actual price is? And I remember when we were doing this study, we had all of kind of the mobile money posters around us trying to figure out what the actual price was as you kind of transfer different amounts. And I have to say, it was a little bit confusing, right? So there's this kind of element of, do you know what the actual price is for transferring this money? You know, when we did this and we asked people about their beliefs for transferring money, you know, the beliefs were remarkably accurate to what kind of the actual sticker price was. So it seems as if people within our sample actually knew. So then the second answer to that question is, well, you know, when you actually get there, are you just going to pay the sticker price? And that's kind of a question of like, well, is there sufficient supply? Is there enough competition? So if you go up to this one agent and this individual says, well, you should pay me $2, but you know the price is only $1, but the next agent is 100 kilometers away, what are you going to do about it? Kind of what's your bargaining power to actually address this? And that's kind of potentially a non-trivial concern. We saw that in the context of a different project we were doing where we were using mobile money or something related to Côte d'Ivoire. And what we saw is that in places that only really had one agent, in some cases, kind of the agents were asking for about 50% of a higher price. Now, as soon as we found out about that, we immediately informed kind of the mobile money operator, and they immediately addressed this with their agents. But you could see that potentially the people who are not necessarily informed, or they are informed, but they don't necessarily have any other options, that they might be paying a slightly higher price. That being said, I would argue that these issues with mobile money are equivalent with other types of money transfer services. And so we saw that with the domestic money transfer services, we saw that with the buses, right? There aren't necessarily a list of prices. And when you get there, you know, if you don't necessarily have a lot of competition, then you're really beholden to that one service provider. And so I do think there is a role for making these prices more transparent for both the consumer, so they can see it right away, having kind of a mechanism to allow people to report if they are overpaying, right? So they're not necessarily paying the sticker price. And then the third, potentially addressing this issue of supply. One of the issues that came up when we talked to some of the agents that had done that, they said is, you know, well, this is what I'm earning on this kind of cash out, which was about 10%, right? And so then that's the question of the incentives. Are the agents being incentivized enough to be an agent and to have enough liquidity on hand? So it's kind of a complex set of issues, but great question, thanks.
Yeah. I think Alison has lots of questions now, so please.
Thank you. In fact, one of my questions was really, I might have just missed it. I was trying to understand when the study was done and whether you were able to ascertain whether it was being used for social protection or that you were just speaking about its potential to be used, but it seems with such low numbers that its use for social grants and that might not be feasible currently.
Yeah, so the study was done in 2017 for this one. That being said, and 12% of people had ever used it in their life, 3% had used it for their private transfers. We had done another study with an NGO using it for social protection payments back in 2009, 2010. And it was successful in the sense that it went off quite well, right? So it really reduced costs. There was kind of a reduction in leakage. There were a whole other of positive outcomes. That being said, that adoption wasn't necessarily sustained. And so I think that the takeaway here is that there is a potential to use mobile money for social protection payments. We've done it ourselves in the context of other projects with the Ministry of Environment and the Ministry of Agriculture. But the existing infrastructure isn't really there. And so it takes a lot of coordination with the mobile money providers and a lot of coordination with some of those agents. So it just doesn't necessarily happen organically. And I don't know if that's necessarily something that's sustainable or something that could necessarily happen at scale. So if you're thinking about social protection payments and you only have 7 agents in an entire region and you're sending kind of payments to millions of people and everyone goes en masse to those agents, they're certainly not going to necessarily have the liquidity. And then that kind of might cause additional issues as well. So it can happen, but I think that it really does require a lot of foresight and forethought and collaboration with the private sector in that case. And the really thing here is kind of where are those bottlenecks? Where are those agents happening?
Alison, why don't you follow up? You had more questions, clearly. Why not?
Well, my other question really was whether you'd had the opportunity or you were able or intended to explore any negative dimensions of mobile money. I think, as we've seen us moving beyond mobile money in Kenya, we have all these new issues of debt and things. But I'm thinking in this context, where we're really just talking about mobile money, whether you were able to ascertain whether people were having to pay a premium for using somebody else's mobile phone to send or receive funds, or perhaps that they didn't have control of those funds if they were sent to a member in the household who controlled the phone, who owned the phone, and they might not have the same discretion around a cash transfer that they received in hand.
Yeah, that's really interesting. So I think I'm going to refer to this study, but also the study that we had done 11 years ago, where we were really comparing kind of cash transfers that were made in cash as compared to cash transfers that were made with mobile money. And both of them were to the female recipients of the household. Actually, what we saw in that case was that mobile money allowed the female recipients to have more of a say about how the cash was used. Because when it was happening as in cash, meaning an envelope was handed, what that meant is that the cash transfer was immediately observable to everyone, either within the village or within the household. And so there wasn't necessarily a lot of time to discuss how the money was being used. Whereas when it happened via mobile money, there was a lag time between kind of when the money arrived on the mobile phone and when the money was actually cashed out. And so that allowed kind of, in this case, female recipients within their household to have a greater say of how the cash was being used. We saw that it was used for more diverse reasons, and we saw that that increased levels of food security. So that was super interesting. Now, that being said, if you look at kind of fast forward 10 years, and this is kind of what I was responding to what Bob had actually said, what we have seen is that overall, those who are using mobile money are predominantly male, because they often are the ones who own the mobile phones, and males often have higher levels of literacy. And so, if we think about using mobile money as a way, you have to look at kind of the handset, you have to memorize what your PIN number is, that then might kind of prioritize or favorize males as compared with females within the household. But that being said, at the same point in time, kind of most of the members of the household are males who are migrating, and they're sending back money to female members of their household. So there is a potential here to potentially use it. And as I said previously, both males and females seemed willing to use mobile money and were willing to pay kind of a similar price. But we haven't kind of gone much beyond it. But then we know that with any technology, there's going to be potential negative consequences for particular populations, either across kind of the population or also within particular households. And we didn't go into that in a lot of detail, but just to say for sure those types of things are there, and we can't really say necessarily a lot about that.
Alison, is that enough? I think you came back with another point.
No, I was just saying the first study is very interesting and aligns with a lot of the, our findings from our demand-side surveys. But I was just trying to distinguish the case where, in many cases, the woman actually doesn't control the device. So I think all those indicators that you've spoken about, where women were actually receiving the remittance on their device. But it was just a clarification. I'm sure there's other questions.
Right. I have one more from Donna, and then I think Bea is also waiting. So first, Donna, maybe.
Hi, it's me again. Yeah, I just wanted to take a step back and think about the kind of broader question of why we want people to use mobile money. I mean, this is a question that I also ask myself, you know, if they receive it quickly, are they not more likely to spend it quickly if they can spend it? So can you first maybe speak about how we can think about maximizing the benefit of using mobile money, tying it in with, you know, savings account or incentive to save? So that's the first question. And then the second question is, like, in terms of infrastructure issues, you know, in countries where you can't pay for goods and services using mobile money, or, you know, pay for anything online, there is still an incentive to use cash. So, you know, whatever we do, we're still going to be constrained by the infrastructure issue from the market side of things. So yeah, so again, two questions, sorry.
Yeah, no, great questions. Yeah, for the first one, right. So when we went into this, I mean, I want to hesitate to say, like, you know, the purpose of this research wasn't to say, like, you know, why aren't we doing this thing, right? It was really to try and better understand, if you have this new technology, how do the costs and benefits of this technology weigh up with the alternatives? And if you compare the alternatives, at least in terms of the cost, it seems as if it's about the same cost or slightly less expensive in terms of the money that you're paying out and your distance to an agent. Even though there's very few agents, there are definitely more agents as compared to the alternative. So in the cost mechanism, it seems that there's fewer costs, but here I'm not talking about, do you know how to use the mobile phone, things like that. From the benefit perspective, what we've seen, you know, in Niger, but in other countries, is that it really seems like being able to get remittances at times when you need it the most allows you to smooth your consumption in the face of shocks. So you raise the issue about, you know, if you get the money, are you more likely to kind of spend it more quickly? I think that really depends. I mean, the work that we had seen previously in Niger, when I talked about these cash transfers, I want to reiterate that these cash transfers came after pretty much a major food crisis. Basically, there was a famine in certain areas of the country. And so basically the marginal utility of this income was very, very high. So as soon as people got these cash transfers, they immediately spent it on food. About 90% of the cash transfer went to basic foodstuffs, and the rest were other basic needs that they really, really needed. And I think the question would be, is if you provided those cash transfers over the course of a year, where we see that the marginal utility of income actually changes, do people immediately spend it? Or do they take that and either save it on their mobile phone, which we have not seen in Niger in our work? That doesn't mean it's not happening, but we have seen that in Tanzania. Or do they take out the cash and save it via another device, such as a small savings box or in their Raska or their Aska? There's a lot of evidence to suggest that that's actually happening. We've done separate work on Niger on savings. You raised the separate question about kind of going cashless, right? This whole idea that maybe the system would work better if you had digital financial services, and then you didn't necessarily have to cash out. You could go to kind of a local agent or a local shop and you could pay. And that's kind of a separate but a really important question. I mean, I think we can kind of debate the issue of going cashless and whether or not, you know, being able to do that is a necessary precondition for any type of digital financial service to work. I don't know necessarily if it is. I mean, I think that you could look at other potential uses of digital financial services for salaries, for cash transfers, for remittances and things like that, and say that, you know, maybe we know that the end uses is just going to be cash, but just reducing those transfer costs is going to be kind of welfare enhancing enough that it might be worthwhile doing it, at least from the government perspective. And then it should be from the beneficiary perspective as well. And then the next step is, you know, do you have to even have the cash in, cash out system?
Well, we're almost running out of time, so I bear maybe with the last question, and then we'll close. So maybe Jenny, if you anything that you feel like you should have said as well, you can come in then as well. But Bea, maybe first ask the last question.
Thank you, Stefan. It's a very quick one, and also just going back a bit to your point about interoperability. And one thing that I was thinking in terms of interoperability being really important is that if you want the network of agents to expand, there's this sharp trade-off between having multiple providers operating in the country versus having one big operator that comes with all the concerns of having a monopolistic operator in the country. So having a regulation that really enforces the interoperability element of the mobile money network is really important. What other aspects do you think that would be relevant from a public policy perspective or from a regulatory perspective to consider in terms of designing a regulation that would foster mobile money adoption in countries like Niger?
Yeah, I mean, I think so. You mentioned this important issue, which I think was like, regulation that forces interoperability. And I think that what we've seen in Tanzania, in the previous work of Tanzania, is that while it might take a lot longer, having kind of non-legal enabling kind of policy can also be just as effective. It might take a lot longer, but if the mobile money operators come together and can agree upon interoperability, which is beneficial for all of them, that seems as if it's probably going to be more sustainable in the longer term. So that's one thing. The second thing that we talked about gets back to Liz's question earlier, which is this kind of like regional approach, right? If you think about the fact that kind of a preponderance of migrants go to Nigeria, which has a different currency, right? Ensuring that these mobile money operations can talk to each other across these different currencies is going to be crucially important in order for people to get these transfers, as opposed to depending upon friends and family members to do so.
Great. Jenny, it leaves me then just to thank you very much. It feels like we've really questioned you. It's like one question after the other, an interrogation almost. But it's been great to have you talk to this work. And actually, we asked you questions far beyond the particular paper, but it's just that it's so stimulating. And you've been a champion and an expert on this area, so I think a lot of people used it as an opportunity. But thank you very much for this presentation, and also thank you for the audience to sticking with us. And well, hopefully we will see many of you, or at least have you on the line with the next seminar of this series. But thank you very much, Jenny, as well. And if anyone knows how to applaud online, let's do it now.
Thank you so much, everybody. I really appreciate it. And please, you asked tons of great questions about regulation and regulatory frameworks. If you have any insights or things, this is something that I think we really need to learn more about. So thank you so much. I really appreciate it. And have a good day.
Okay, then. Thank you very much. Then. Bye then.
Bye.